Broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us today. We are going to take a deep dive into the One America Annuity Care products. Please write down any questions that you have, which you are probably going to have several, and I will follow up with each and every one of you after the webinar. First thing we've got to do is some housekeeping. So we're going to go over IAMS Business Builders, which is our referred producer program. If you refer an agent to IAMS and the agent contracts with us, you will receive a $50 bonus. Once your agent does write business, you will either receive $100 or 20 basis points, whichever is higher. The other thing we need to discuss is our marketing reimbursement program. So for every $100,000 of premium that you submit and get issued, you will receive $100 in your marketing reimbursement account. We have very few restrictions on that account. That is designed for us to help you cover the cost of conducting business. You simply submit your receipt and we will cover half of whatever the expense is that you should incur. Next thing we are going to talk about is our new producer builders. These are for newly appointed agents with IAMS. As you can see, we do have 3 levels: the $100,000 tier, $300,000, and the $500,000. And all of this is within your first 180 days of contracting with us. So if you write $100,000 worth in business, you can choose from a $750 cash bonus, a free producer website for 2 years, or the newest iPad. If you can hit that $300,000 level, you can receive a Social Security seminar training program and a 3,000 piece mailing, $2,000 in your marketing reimbursement account, or a $1,500 Visa gift card. Should you be so ambitious and hit that $500,000 mark, as you can see, you have 2 seminar coaching options, or you can reward yourself with a Ritz-Carlton travel package for yourself and a guest. Next thing I want to talk about is the back office support that we do give you here at IAMS. That is what we pride ourselves on. So the minute you get a case, you give us a call. We're going to help you with all of your case design, illustrations, product training link, applications, brochures, anything that you need to get that piece of business written. Once you get that piece of business written, if you send it to us, we are going to scrub that application, get it sent up to the carrier, and then we will follow up on that every 3 business days to make sure that it's processed in as timely a manner as possible. The other thing that we have is our website, which has business building tools and resources on it. We have forms at your fingertips as well on our website. You can also do life and annuity quotes. We have a couple different gentlemen that do have coaching options for you. And we have our paperless contracting system. So once you complete the agent data packet, adding an additional carrier is as easy as sending your marketer an email and requesting to be appointed with that carrier. Our creative marketing solutions is incredible. We have very, very talented graphic designers to help you with websites and digital marketing strategies, social media consulting, business cards, brochures, logo design, anything that you need from a creative standpoint, mailings, anything that you're going to do, we are able to assist you in getting that completed and having it look very professional. And now we can talk a little bit more about our website, which has our life term quoter on it. It also has our annuity grid. You can see current MIGA rates, long-term care product grid. It has our current life and annuity news on it, and you can access forms as well. IAMS Wealth Management is another division within IAMS. You need CFC or a 65, and this is designed to help you increase your revenue. So if you have a client with $500,000 and suitability is only going to take 400,000 of it, it just gives you another avenue to place that business somewhere else where it will be accepted. You can reach out to Charles or Mike within our office, and they would be happy to talk to you more about IAMS wealth management. And with that, I am going to launch a poll question. If you'd like to receive more information about IAMS wealth, please answer yes or no. Your participation in this is greatly appreciated. Give it about another 10 seconds, and I'm going to close out that poll, and we're going to move on to the next slide. Right. I'm going to close out that poll. Thank you for participating. Oops, went a little too fast. Okay, the last thing we're going to talk about is our life and annuity academies that we do host for producers. And with that, I'm going to launch another poll question. If you would like more information about our life and annuity academies, please answer yes. If not, please answer no. But I do appreciate your participation in these polling questions. Our life and annuity academies are designed to be a 2.5-day marketing summit. So we're going to fly you in. It's all expense paid. We bring in our top 4 producers. They're going to go over the marketing strategies that they have used over the course of their careers to get from the bottom to the top of the industry. You're going to have access to software tools. They're going to go over advanced annuity topics and wealth transfer tools. We're going to talk about income riders. We're going to talk about large case life marketing, top producer turnkey seminars. They're going to go over everything that they have found that's worked for them. And then you will be given an opportunity that's a once in a lifetime opportunity as far as a learning standpoint for life and annuity sales. And it looks like everyone has answered. I'm going to go ahead and close out that poll. And with that, we are going to go on to our next slide. And I'm going to hand this broadcast over. We are going to be joined today by Roger Cantu. He is with One America, and he is going to give you an in-depth look at all of their products on the annuity side for long-term care.
Nicole, can you
I can hear
see
you,
my screen?
and I can see you.
Awesome. Well, thanks for the introduction, and I want to welcome everyone on the call. I'm looking forward to running through this with you today. I appreciate the opportunity Nicole gave me to walk through it. We are going to focus, as she had mentioned, on our annuity-based solutions. Just real quick, I'm the regional VP. I support IAMS and other marketing organizations. But in this case, we're focused on our annuity-based solutions rather than the full breadth life and annuity. We do have 2 contracts that we offer, again, totally focused on the long-term care benefits. But the annuity contract has some distinct advantages, certainly over traditional annuities or even those with nursing home riders. So even within that portfolio of plans, so we have asset care being the life contract and real clever marketing people there, annuity care being the annuity-based solutions. But again, stressing here that it's not about growth, it's not really about income to live on. It's all about the long-term care benefits you can achieve with our contracts. But as a result, pick up some substantial tax advantages you otherwise wouldn't get. And this really should be titled Repurposing Non-Qualified Annuity for Long-Term Care. Or another way of saying it is tax deferred to tax free for LTC. So I'm going to walk through these advantages, focusing my energies, of course, on the annuity care solutions, and specifically our indexed annuity care and annuity care 2. So real quick, this is One America's is a holding company for state life. It's a $76 billion marketing organization with several insurance companies. We've had record sales, assets, earnings, capital, and sales force growth for the last 9 years, including last year. We have a Comdex of 95 out of 100. The industry average for our size company is 91. We're A+, AM Best rated. That's been that way since 2011. And between the original company, Golden Rule Insurance, and now One America, these plans have been on the market for the last 30 years. The annuity, the last roughly 20 of those years. So again, the focus here is on annuity-based long-term care solutions. This is an overview of 2 of the annuity-based solutions. And I, please, would like you to think about this in terms of really 3 market segments. One, obviously, is existing non-qualified annuity owners you have on the books. Don't perhaps intend to use it for income, but perhaps have substantial tax-deferred gains on those contracts. So a couple of key questions I would have you consider is, number 1, is this annuity on the short list of assets you would use should you need long-term care, or should you no longer be able to take care of yourself? I'll repeat that. If this annuity that you have with tax-deferred growth, is this annuity on the short list of assets you would use if you needed some assistance for long-term care? I repeated that because that's made a couple of folks that I work with millions of dollars in production and hundreds of thousands of dollars in commission by simply approaching clients with those questions, right? So do keep that in mind. Number 2 are folks that perhaps couldn't qualify for traditional long-term care insurance and or the life-based approach, meaning their health qualifications from a mortality standpoint restrict them. They're a lot more forgiving on the annuity-based solutions. And then finally, so that's second, and the third is folks that are over age 80, and I'll go as far as saying really over age 75. We write our life-based solutions up to age 80, but much past 75, the annuity actually looks more attractive. We are going to talk about 2 plans, one of which can be written up to age 85, and because of its easier underwriting, folks, I'm telling you, we do write quite a few folks over age 80. So the very basic concept of this, first and foremost, is all about using an existing annuity to protect their assets against long-term care. What happened there? Wow, everyone's probably seeing my desktop, so I don't know how that happened. Let me bring that back up. Technology is your friend, or
Sometimes.
not. Yeah, that's right. So bear with me, it's coming back up, there we are. So sorry about that. So we are really on the concept, and that is repositioning existing assets, right, to leverage with tax advantages to protect against long-term care exposure. This could easily apply to the annuity as much as the life-based plan. But when asked clients, if you or your spouse were to need care, which of your assets would you liquidate first? It's generally the conservative piece of their monies. And certainly $100,000 isn't enough. That's kind of the starting cost in most parts of the country a year for long-term care. But this is allowing them to reposition a portion of those assets, money that they already intend to use to cover long-term care, meaning self-fund, and get leverage on that money, either doubler, tripler, or up to lifetime coverage, right? With, again, some distinct tax advantages. So it's all about protecting the better part. Let me put this laser on so you can see it a bit better. Protecting the better part of this portfolio, insulating against that cost. So again, that's what we are trying to identify the annuity to do, right? But also with that tax advantage. And that revolves around the Pension Protection Act. This applies to only non-qualified dollars because one of our funding plans does take qualified. But let's just walk through real quick the Pension Protection Act. It was passed in 2006. You know, it's 1,182 pages on revising how pensions are treated in the US, but a page and a half of that legislation established a style of non-qualified annuities that walks and talks and smells like long-term care. And after the 1st of January 2010, almost a decade ago, the benefits from those PPA compliant, Pension Protection Act compliant annuities come out tax-free. Or another way of saying it is you have an existing annuity that with a basis of 50 and a gain of 100,000. It's a lopsided annuity. But the bottom line is many, and you'll see in a second, these folks consider this their go-to money for long-term care, which means this is going to be taxable. Again, you posing the question to root that out. You know, is this on the short list of assets you would use for care? If they did, the answer is yes. If they did use it where it is, I mean, 99.9% of non-qualified annuities are not PPA compliant. So if they did use it and withdrew the money for any reason, including long-term care, they'd pay taxes on the gain. So they're not going to get 150. They're going to end up getting 125 net of taxes, right? So what the Pension Protection Act did was categorize a style of annuity that for that reason and that reason alone, long-term care, the benefits come out tax-free. So we are 1035 exchange are repositioning this non-qualified annuity for a HIPAA qualified, it's Health Insurance Portability and Accountability Act, HIPAA qualified PPA eligible annuity. I know it's a mouthful, but call this a long-term care annuity. And again, we have 3 of the 5 that I have approved, and I'm in Dallas, Texas. So we have 5 approved, we have 3 of those. We're going to cover 2 of those today. A withdrawal from this now annuity for long-term care expenses anytime after the date is entirely tax-free. So you've circumvented legally the taxation on the gain in the contract, and that's just phase 1. We're going to create leverage on that money for long-term care beyond it. Now, why is this a big deal? Because a Gallup poll 2009 found that of non-qualified annuity owners, 83% of them intend to use their annuity to avoid being a financial burden on their children. I mean, my goodness, what are they talking about here? Well, let me get more specific. 73% of them specifically intend to use that annuity as an emergency fund for catastrophic illness or nursing home care. Well, where it is, it's taxable. You have an opportunity to reposition those monies to address long-term care and do it on a tax-free and leveraged basis. The other thing I want to drive home here, and this is hugely important, many of the contracts perhaps that you have in your client life, the non-qualified annuities there, they may or may not be free of surrender charge. It won't be a restriction, but they may have an guaranteed interest rate higher than the prevailing guaranteed rate, which is roughly around 1%. Many of those sold, in the economic crisis, mid-2000s, had a 2.5, sometimes 3% guaranteed rate. Many on the call and many out in the broker, in the advisor world, feel that those plans can't be moved because it's not a suitable exchange. I'm telling you, that's hogwash, because the rule is never about interest rate. In order to have a suitable 1035 exchange, you have to provide additional value to the client, period. It's very vague, but everyone in the annuity world revolves around it being a better rate. It's about making the money better for the intended use of the clients. I'm going to go through this contract and realize that we get policies that have a guaranteed rate of greater than our guarantee of 1% every day, every week, and not one of them have been turned back because we are providing substantial value, not because of the PPA alone, but because of the leverage. So let's talk about the indexed annuity care policy first, and then annuity care too. Again, it's all about taking this existing annuity, or this could be cash as well. And in fact, this is one contract that does have the use of qualified funds, but again, the tax advantage here only applies to non-qualified. So we're looking at 150,000 that we want to convert over to this now tax-free annuity for long-term care expenses. So not only is it super liquid for long-term care, but again, you can add to that additional benefits. So the index contract operates this way. You are going to reposition this 150, let's say, into this fixed indexed annuity that is PPA compliant. If it's needed for care, and this is inability to perform 2 of 6 activities or cognitive impairment, just like traditional long-term care, including home care, they can draw down on that annuity, and this is super liquid, in 24 months. If it's a couple, husband and wife, which you can do, husband and wife, by the way, even if he is the owner of the annuity. You could 1035 it over and add the wife only, spouse only, as an eligible person. Then it's drawn down in 2.5 years or 30 months. But we're going to stick with a single case for now. So really, again, by moving it to the annuity, you're just creating a super liquid tax-free annuity for long-term care, right? What we want to do is create leverage on top of that. So you can add to that, it's optional with this contract, a rider to double the benefit. So in a single case of a single, it'd be 24 plus 24, or a total of 48 months of benefit. So not only you get the money out tax-free, but you leverage it up twice. So really now you're creating 300,000 of tax-free money for long-term care. And this rider could be funded separately, or it could be part of the 1035 exchange. That's rider number one. Number two is a tripler. So again, single case, if the base paid out in 2 years, you could add 4 more, or a total of 6. 2 plus 4 is 6 years of long-term care benefits, all of which would be paid out tax-free. So it's a monthly distribution tax-free for 6 years. And finally, you could add to it lifetime coverage. Here are the stats, 40 to 85. Again, it's fixed index, so it's tied to the S&P 500. We'll get you the detail on that. Realize that the caps and pars are going to be less than every other indexed annuity care or annuity product on the market. I mean, in my recollection, because it's not about that. We're trying to get additional growth within the contract, but it's about tax-free and creating that leverage for long-term care. So let's look at a case where we have a 60-year-old female, right? She's by herself, maybe husband passed away, could be a divorcee. We don't know. She does not want to be a burden on her children. She's one of those that if you know, care is needed, she can't buy long-term care insurance because she's a diabetic. Well, again, with the annuity-based solutions, a bit more forgiving. It's not guaranteed issue, but it's very streamlined underwriting, no question. So she has 150,000 in a non-qualified annuity, and again, does not need that for income. Pose that question: if you were to need long-term care, is this the place that you would go? The answer is yes. So remind her that with the gain of 100,000, she's going to net after taxes, after she's bonused the government 25,000, she's going to net 125. So here's the question: if I could show you a way to reposition that money, not have to pay taxes on it for long-term care, and even create a lifetime benefit, would that be of interest to you? I got to tell you, what female living by herself who doesn't have long-term care insurance, sees the need, is going to say no to that? They're not. So let's reposition that money here. And if care is needed, she's able to access this tax-free, and it will be liquidated in 2 years. Now, she could do the base policy only, but gosh, if you have an opportunity for very little additional premium to double, triple, or even create lifetime coverage, generally they take advantage of that. So that's something that Nicole and the team there at IAMS can put together for you. This is just one option, but it would create an unlimited benefit and would all come out tax-free. What does that ultimately mean by 1035ing and adding the lifetime coverage? It really means that we are creating base policy, roughly $6,300 a month of tax-free money for 2 years, and then that benefit would continue. Now you could add inflation to it, but again, we're knocking out what, $75,000 a year of long-term care benefits for the rest of her life, and she's only paying an additional $2,120 a year of guaranteed premiums for that coverage. So you're moving the annuity over 150,000, and then you're adding this as an additional rider. Or you could just take the 150 and move, let's say, 125 into the base annuity and 25 and buy a single pay rider if you wanted to, and then you wouldn't have an outside premium. Now, this is day one. This is $6,300 now, right now. I mean, assuming no growth. Let's let this thing grow, right? And then have her need care. Mind you, she's 60. She may not need care until she's 75. So let's push this out 15 years and see what happens. Everyone from on the call, if you're familiar with fixed index annuities, know of the step up that is often triggered when you exercise that income benefit. Well, we too have a step up, but it's for long-term care benefits, right? So it's not designed to buy groceries. It's designed to take care of a home health care aide, nursing, assisted living, adult daycare. But what we're projecting is one of two things. One, for our gal who puts the 150 in, that the market, the S&P, right, and her crediting strategies were flat for 15 years, meaning she didn't get one iota of growth, right? So in year 15 at age 75, if she needs care, we run that through this 1.35 or a factor that levers up her original deposit. And you can see that would lever it up to 202,500. So even if the market's flat, she's going to end up having that growth. This is just on the base. We're not talking about the rider that you can add to it for the additional coverage. What I'm saying is her base contract, her 150, is guaranteed to quote unquote grow or lever up. Now, the other is that if she has had growth in 15 years, let's say it's grown to 218 over that 15-year time frame, based on her crediting strategies and a robust S&P. Well, we run that same account value at that point through a different, it's the same year 15 here, but it's a different formula. And whichever of these is higher, that's what would be paid out to her. So this is the payout in year 15. And of course, you can see between those two that the account value actually would be quite a bit more. So let's just take 250 and divide that by 24 months. That's what she initially gets. This is outside of the rider. That would take her $6,300 a month of tax-free money, folks, to $10,416 a month. It's right roughly there, $482 a month. My bad, undershot it. That's what would be paid out to her. Again, tax-free, and we paid out for 2 years. Of course, we're going to add that rider to increase that even further. So our gal may have this 150. She has it intended for care. It's got a bullseye on it for paying taxes. Should she need it for any reason if she died? But again, you may look at that and say, I don't know if I can do anything with that. It's got a guarantee of 3%. You absolutely can, and this is one of the ways to do that. Another is to utilize our Annuity Care 2 policy. Now, this is a different animal, quite a bit different animal. Because if you'll recall, on the index contract, you're moving the whole thing over, the 150, right? And again, could be in a CD if you wish, but I'm really trying to target the older annuities that maybe are quote unquote trapped in your client files. Here, you're rolling that same money into that same PPA compliant annuity, but this is fixed rather than fixed index. And rather than coming out of pocket, like in the previous example, remember that $2,100 a year for the lifetime coverage? Here, like an M&E charge on a VA contract or a fee coming out of your growth for that income benefit, like that, we have an internal charge that buys that rider. Now, we don't have the option of lifetime coverage, but we have a very robust optional rider benefit. Still, all tax-free coming out, and it would pay out in the same manner, meaning it would pay out over the course of 24 months for a single life, 30 months if it were a joint contract. So to which we can add, and it's not an option, you must add with Annuity Care 2, one of 3 additional riders. You're going to add either a 36-month rider, a 72-month rider, or 108 additional month rider. Now, keep in mind that walks and talks and smells a lot like the index contract, right? Except it doesn't have lifetime coverage, and it's not quite double or triple or what have you. The difference is rather than coming out of pocket, we have an internal charge, which, because it's PPA compliant, Pension Protection Act compliant, it's going to come out without any taxes. In fact, it's going to be FIFO accounting on that fee. Yes, you heard me right. When it comes to additional benefits out of the annuity, like this, or payments made for long-term care out of the annuity, right, directly, meaning divided by 24 months, it's going to be basis first. It's the only exception to LIFO-FIFO rules. So that all revolves around the Pension Protection Act. So she's going to choose, depending on her age, there's limitations there, to add either a 3-year additional, so it's 2 plus 3, a total of 5. Remember, the annuity pays for 2. 2 plus 6 years, right, 72 months. 2 plus 6 is 8 years. It's the average Alzheimer's day, by the way. Or she could go for the gusto and add 9 more years, 2 plus 9 being an 11-year total benefit, all tax-free, and it would more than cover at that range a catastrophic long-term care stay. Now, of course, with each one of these, the internal charge ratchets up, right? So keep in mind that when she puts the money into this, it's a fixed contract. So the fee coming out to add this is going to make the annuities growth flat. And if you go for the gusto, make it even, this larger leverage, you still get it tax-free, but if you add the larger leverage, that's the greatest fee. You may actually eat into the principal. But in my 30-year career, on more than one occasion, I've had clients willingly go into this contract with their principal balance reducing. Now, why would they do that? Because we're creating 11 years of long-term care protection, right? Instead of tax-free, instead of, maybe 1 or 2 years of long-term care after they pay taxes on it and pay the government, right? So they're trading what? They're trading liquidity and growth for tax advantage and leverage, right? So you have a 2.5, depending on their age, a 4 or 5.5 times the original deposit on the Annuity Care 2, 40 to 80. And again, this is non-qualified only. So let's go through an example related to the Annuity Care 2. So this story is actual case. I was in just right near the, the Rangers Stadium in Arlington, Texas. Met with a gal who had $168,000 in non-qualified annuity. Now she put in her 40s, $68,000. She was sick of getting, I don't remember what it was, like 4.5% at the bank. So she put it into this annuity, and it's been in there cooking for 20 plus years. Well, she's got a gain of roughly 100,000. So 168 in her annuity. Simple question: if you were to need some kind of long-term care, is this on the short list of assets you would use to pay for it? Or, is this annuity on the short list of assets you would use to pay for a long-term care event? Yes. Okay. Well, where it is, you're not going to get 168. It's going to be roughly 143. Well, why is that? So is that surrender charge? Oh, no. Well, surrender charges have long since gone on this contract, but you have to pay taxes on the 100,000 of gain, right? So you're going to pay the government. Now you'll get the 168 out, but you're going to end up having to pay taxes on the gain. That's for any reason: your death, or fix your water pump on your RV, or long-term care. But if I could show you a way to reposition that to a long-term care annuity and have those same withdrawals come out. Now this was 2012, it's a long time ago, but have those benefits come out for long-term care, including care in your home, tax-free. Would that be of interest? Well, she was hooked right there. Right? This is, yes, absolutely. But it's going to, go one better. Now she was 65, right? Again, annuity had a gain of 100, basis of 68. Right? And I believe her interest rate at the time, a guaranteed rate, was 2 or 2.5%, not sure. Well, we were at like 1.5 at the time. So let's propose to her repositioning via 1035 exchange, no taxes, repositioning that money that, should she need care, would be paid out to her for long-term care expenses tax-free. But again, what we wanted to do is lever that up beyond the taxes. So she would accept a fee, and it's right on the illustration, to buy 3, 6, or 9 additional years. 2.5, 4, or 5.5 times her original deposit of 168. Right? Well, she had an Aunt Tilly, I think it was, going to the nursing home for 7 years. So she wanted to make sure that was covered for at least that. Again, and tax-free. So 2 years out of the annuity, she added the rider for 6 more years, 72 more months, and a fee accordingly. Well, her annuity pretty much wasn't growing after that. Actually went down a little in value, like I'd mentioned. So let's take a look at that, what that might look like for her. Again, 65. So she put in the 168, agreed to this charge coming out to buy her that 72 more months, and she now has $670,000 available for long-term care. It's day one, immediate leverage, all tax-free for long-term care. Now, if you don't think that's a good deal, pretend this is your mom and you sold her this annuity, and you're the beneficiary of the annuity and her caregiver should she end up needing care. I'm asking you now if you feel like this is a good deal, right? Because let's just walk through it. If she needs care, now you have the resources to be able to address that care for an extended period of time without any income taxes. And if mom passes, yes, you've neutered the growth on it, but again, it's all about protection. But if she ends up needing that, you would have avoided paying income taxes yourself on that annuity, right? So it's really all about how we're repurposing this annuity for a different reason, not growth, not income to buy groceries, but truly as a leveraged tax-free protection against long-term care. So again, here's the illustration. I just wanted to show you that that is almost $7,000 a month in long-term care benefits lasting for 8 years on that contract. So the underwriting for annuity care, well, all annuity care cases, when you add a form of the rider, are underwritten with a very short, just cognitive phone interview, an MIB review. If you're not familiar with that, it's Medical Information Bureau. Just make sure that her question, 11 questions on the app, that's it. It's not like a full traditional long-term care quote or app, but we want to make sure those questions correspond to her records of the MIB, and then we do a prescription drug check, right? That's all behind the scenes. Her phone interview is really a cognitive review lasting maybe 10 or 15 minutes. Now, that's if you do add the COB. With the index contract, if you're maybe a bit nervous about her on them on a phone interview, you could do base policy only, giving her that tax-free money basically for 2 years only. Remember, you're not leveraging it up. This is the index and our fixed contract, which I did not cover today. And there would not be a phone interview. So I've had situations where gal's 82, right? She's, nervous about the phone interview, thinks she's going to get a trigonometry question or what. I'm kidding, of course, but you think she may blow it, right? You could do base policy only and no interview, right? I've also had a gal who had hard of hearing, right? She didn't want to do the call. So, instead of getting 5 years, she was limited to 2, but it still was tax-free benefits. Unlike most hybrid policies that are out there, like our asset care and others that are out there, annuity care represents a simplified underwritten pivot from that life base, as well as standalone long-term care. So rather than going the direction of a pay-as-you-go, use it or lose it, or even the life-based hybrid with its maybe more robust underwriting, this is a pivot not only for cases that can't be written on the life side, but doing any of those plans altogether. Just go to those existing annuities, challenged health, and or those over age 80. Now, I want to stress this challenged health thing. I know there's going to be a lot of questions probably about this. If you're already cognitively impaired, have a diagnosis as such, or have an ambulatory issue, meaning you're not probably familiar with this term, a morbidity-related condition, then an annuity care may not be an option. Alzheimer's, Parkinson's, MS, a debilitating stroke, even the annuity-based solution won't work. But there are folks out there, even in their 60s and 70s who've had mortality-based conditions, heart attacks and cancers and things that shorten your life expectancy but don't necessitate a long-term care event. They could be and likely would be better candidates for the annuity-based approach than life. And of course, Nicole and the team there at IAMS has a pre-underwriting inquiry. So if you do have a case, you can get that completed. We could send that to an underwriter and get their at least informal evaluation of it. And then lastly, again, if you have any case that's just simply health challenged, annuity care could represent that more simplified underwriting. I want to make a quick plug, Nicole, if you don't mind. Every Monday, I do just a 15-minute, if you will, booster shot, so to speak, of our contracts. And this is either a case study, a sales strategy, or the latest marketing tool. This is only available to folks that are point through the marketing organizations I support, like IAMS. I have others, and it not only runs through the sales idea, much like I have today, more with illustrations, but it has a recording to follow. You only have to register one time and you're locked in for all of those. And that's just sort of a supplement. But I do have full-blown training that covers all the life and all the annuity products every week. That's generally on Tuesdays. They're hour-long sessions. I know you're thinking, my God, an hour-long webinar. I don't know if I can handle this guy for an hour. I'm kidding, of course. But each one of those bullet points under these contracts are 15-minute segments. You can plug in, plug out, depending on what you want to learn. And that, again, is the life base. If you sell life and you want to go that direction, that's a session that you can go. That's asset care. What I covered today is very much what you would see on this training webinar, except we do an overview, we include Annuity Care, and with each one of these, I wrap up by going to the whiteboard and showing you how to present it to clients. These are at 10 and 2 Central Time, and each week they flip-flop so that it's, convenient for you to join this session. So at the end of the session, I'll make sure that you get links to join these. Again, you want to list IAMS as your marketing organization so that I can direct them back to Nicole and her team to do follow-up, run quotes, and so forth. If you do have a case, certainly now, rather than wait till after this session, you can reach out to Nicole and her team. So with that, I wanted to open it up. I hope I'm not overstepping my bounds here, Nicole, but open it up to questions that you may have out in the audience. And if you could help me manage that, I'd appreciate it.
Yeah, it doesn't look like we have any. Oh, residual cash values if underused or not used, death benefit.
That's a great question. So as you'll recall, and I think I said it, I always try to say it at least 3 times, that the benefit payable from this is tax-free, no matter what the gain is on the annuity, ... for long-term care. Nothing else. They make a withdrawal from it. There's 10% free withdrawal you have available. Gain comes out first taxable. If they were to die, right? Gain and basis gets paid to the beneficiaries, is taxable to the heirs. This is a long-term care play, but ask yourself, why in the world would the government, our government, take something that for 90 plus years has been taxable without exception, including death, and make it tax-free for this one event and make it exclusive to this one event of long-term care? Well, naturally, there's a bean counter in the home at the White House or wherever, Pentagon, who figured out, hey, we got these millions of baby boomers, right? They got these instruments. Let's empower the insurance industry by, creating this tax-free exception to non-qualified annuities, and let them create the products that'll help these folks. Why? Well, ... They don't want to have them burn through their assets, go on Medicaid, and then the award of the state, right? They just don't have it in their coffers any longer. So legislation like this has been passed really for the last 30 years, and this is the most recent, the Pension Protection Act contract. That's probably more than you wanted, but
we're getting a lot of questions now.
Good.
Can we get the slides used here? Those are.
Yeah, in a slightly different version, but yes, I can get those to you. The reason I say that is because they're all based on, older interest rates that I've shown you. So do keep in mind, you do have to get a regular quote. So it may not involve the quotes, but the graphics I can certainly get in your hands. Yes.
And then state availability.
All states except for New York. We don't write anything in New York and likely never will. You have to have a domicile, and we refuse to do it.
Yep.
In California, now again, it's not a big part of our business because my focus has been non-qualified here, but if you want to fund our annuity contracts with qualified monies, again, no tax advantage, you can do it everywhere except California.
On asset or annuity care, right?
For annuity care only. Yep.
Yep. And I think that's it. If anyone else has a question, type it in quick. Mr. Cantu is a very busy man.
Well, in addition to those, edited slides, I will send you information on the Pension Protection Act, and I'll certainly send the links for the
webinars. Yes. Yep. And I would advise everybody to tune in to one of those, because watching it, having it demonstrated on the whiteboard how the product works gives you a very good understanding of the product, for me at least.
And if I could mention one thing to everyone on the call, especially if you have never gone down the long-term care road, this is not a leap at all. The folks that have been successful going out repurposing these annuities for long-term care have really only subtly changed how they present this to the client. The subtlety is, rather than this, providing X interest rate and tax deferral and potentially this income down the road, right? That's how we're presenting annuities. You're doing, a focus on tax advantage rather than tax deferral, tax free, and the leverage for long-term care. So all I have to do is teach you how to emphasize the long-term care and tax advantage piece of this. And all you have to do is tweak your current presentation. And now you can start to extricate these old annuities that, based on the current interest rates that are continuing to go down, folks, you're probably not going to be able to get them out down the road. I mean, the interest rates won't probably escalate to the point where, oh, well, I can move that out because the guaranteed rate's now back to 3.
Yep.
Uh-uh.
Okay, Roger, how
Do it
about
tomorrow if you wanted to. Sorry, Nicole.
no, I apologize. Stroke with full recovery insurable. And everybody, I have the underwriting guidelines that I can email out to you if we don't get to all of your questions. So stroke with full recovery insurable, ?
If it's a single occurrence, right, and there are no other complicating issues, if it's full recovery, no residual paralysis or memory loss, and it, again, single occurrence, meaning they hadn't had a series of strokes. Now, if all of those match up, but she has hypertension, is overweight, has diabetes, those kind of things can complicate it. But presented, in a silo like you have, the answer is yes, they qualify.
And is there any sort of wait period based on stated existing health conditions?
There is not, but there's a waiting period for the contract, much like long-term care. I'm flipping back to the slides, Nicole.
Yep,
so
perfect.
You'll notice right here, it says elimination period of 90 days. That's typical language for long-term care, meaning when this gal end up needing care, went on claim, the first 90 days, quote unquote, her deductible, she would pay out of pocket, and then this would kick in.
Yep. And that's on every illustration, and I believe it's page 14 of illustrations when you guys do request them. And yes, I will get you out the auto decline issues. And I think that is all we have. And I will follow up with you, all of you, after this webinar. So if I don't have the answer, I can easily email out to the One America team and they will get me the answer. What happens if the annuitant passes before any benefits are paid?
Then the cash accumulation value, which depending on if it's indexed, you're going to have some growth on it.
Yep.
Right. But if it's the Annuity Care 2, you may not have growth on it. But whatever the accumulated value is, would pass on to the heirs just like any other annuity, and it would be taxable to the extent of gain. It's only tax-free if needed for long-term care. So.
Yep, because you do have to remember these are the annuity-based products of the long-term care, not the life. All right. Well, any other questions, and I will follow up with you. Roger, I truly appreciate your time and all of the information you've provided for all of our attendees. It's been very helpful.
Happy to do it. I look forward to working with those cases that do surface. I'm sure there's many. And do look for an email from me, Nicole, that you can forward on to every attendee and those that didn't attend.
All right. Perfect. Thank you, Roger. Have a great day.
Thanks so much. So long.
So long. Everyone, I appreciate you joining us. I will follow up with all of you after the webinar for any questions that you might have or any illustrations you might want or product brochures. Thanks for joining us, taking time out of your busy day. We do appreciate it. Have a great day.